Now, since the SGE opened, over 27,000 tons of gold has been delivered into private hands. Now, some of that would have returned into the Baltic system as scrap. But I don't care, because that just gets redistributed elsewhere. It's not going out of China. Never has done.
No.
And on top of that, of course, you've got the banks. The banks run gold accumulation plans for their depositors. And this gold is not delivered out of the Shanghai Gold Exchange. It is stored within the Shanghai Gold Exchange. So we don't know how much gold there is there. But I should think it's quite a lot. I pencil in a figure.
Recent analysis by Alasdair Macleod paints a striking picture of the unfolding gold market dynamics. He emphasizes that the current surge in gold prices is not merely a reaction to temporary geopolitical stress or inflationary pressures, but the manifestation of a much deeper structural shift. According to him, the global monetary system is approaching a breaking point, with fiat currencies losing credibility faster than central banks can contain the fallout. As debt levels soar and governments continue to rely on deficit spending to sustain growth, investors are beginning to seek refuge in tangible assets. Gold, as Macleod notes, has re-emerged as the anchor of financial trust, reflecting growing skepticism toward paper-based promises and digital currencies alike. Macleod also highlights that central banks, particularly those in Asia and the Middle East, are leading this transition. Their persistent gold accumulation signals a strategic effort to hedge against the declining dominance of the US dollar. Nations such as China and Russia are now openly restructuring their reserves, using gold as a foundation for trade and settlement, effectively preparing for a post-dollar financial order. This trend, according to Macleod, is irreversible. The West, meanwhile, remains largely distracted by short-term market narratives and political maneuvering, failing to grasp the magnitude of what he describes as the quiet de-dollarization revolution. Now, we present the clips from Alasdair's interview on gold price targets. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Look at the demand side. So far, this hasn't mattered because nobody wants to buy gold. I mean, any investment manager isn't going to earn fees by putting his punters into gold. He would rather put them into something which is going to pay him a bit more. And not only that, but the regulators are on his side. The regulators turn around and say that, physical metals are not regulated investments. But of course, this was why they said they set up ETFs, to get around this regulatory hurdle. But the ETFs are beginning to grow. People are beginning to buy into them slowly. But the other thing, which I think is very important on the demand side, is that we now see analysts at the major US banks turning around and saying, we believe gold's going at 4,000, whatever their reasons. I don't care. I mean, they don't know what they're talking about. I reckon that's my default assumption anyway. But, the fact that they are saying it, and the fact that the investment managers within those banks, who are typically managing or responsible for over $1 trillion, we're looking at banks like Goldman Sachs, Bank of America, Citibank, Citicorp, whatever they call themselves now, etc. We're talking about huge numbers. They haven't got any. I don't think they necessarily know how to get it, actually. I mean, so that, this is interesting. When you look at the complete investment management universe around the world, it is estimated that portfolios are worth some $300 trillion. $300 trillion. Now, gold ownership of that, you just look at ETFs and maybe sort of make a few assumptions about, bullion being stored and so on. But, basically it's ETFs and nothing else. It's less than 0.5% of that. I mean, it really is. Less than 0.5% is in gold. And yet you've got these behemoths in America now thinking, oh, we better buy some of this. Now, to put it into context, my China story suggests that the amount of liquidity, which is unspoken for, including jewelry in the West, is probably in the region of about 40 to 45,000 tons. That's all. That's it. We can see what's in the vaults. We can't see what's in the Swiss vaults. That's something I don't know. I would, someone gives me a number, it'd be super. But I think quite sensibly, the Swiss don't produce these numbers. That's what I would assume anyway. But it does mean that if a 1% increase in allocation, portfolio allocation of that 300 trillion was to take place at current prices, you're looking at 25,000 tons. Where's it going to come from? I mean, the answer basically is that we're heading for the most enormous crisis in the gold market. And the figures are very different for silver because being an industrial metal, etc., but the same principle applies. The liquidity is just simply not there, which is why it's sort of hurtling up $1 a time at the moment. This is a squeeze on the system. And, this is very serious. And I think so, I can understand your punter selling off, $1,000 below the current level and maybe living to regret it. But, I can understand that. But the bit he's missing basically is he's going to be out of the market on the biggest, sharpest squeeze probably seen in history. I think that's where we're heading.
Yeah, and as you rightly say, Alasdair, where is the gold going to come from to meet this sudden demand? And you're talking about institutional money here looking to get involved in gold. And I mean, as you say, so 0.5% is how do you even move up from that point? How do you even look to buy 25, 30, 40,000 tons of gold? I mean, it is going to require at least that amount of gold. So it's not coming out of China. It's moving into China. And one of the interesting things that I've noticed is I know of two institutionals who won't deal in London or won't deal with any LBMA CME product. ETFs, they're buying ETFs in Western-facing SGEI vaults where they can trade it. You talked about liquidity. You nailed it. It's all about liquidity. That's where you're going to find your liquidity. Not here, but there. And you've kind of put some numbers around that, which all makes sense.
Well, I would question whether you're even going to get the liquidity over there. I mean, basically, the history, if you like, the more recent history, following our very successful gold standard, back in the 19th century, the history of the 20th century is that central banks grab the gold and they won't part with it at all. The idea that they're actually going to go on a gold standard and, say to all comers, we'll exchange our currency at a rate which is as follows. And, if you're not happy with our paper, then come and exchange it. I think we're an awful long way from returning to those days. You're not going to get liquidity being released from the market. I think that's the key thing.
He further explains that the current phase of gold revaluation is still in its infancy. Physical supply constraints are tightening as central banks absorb record volumes, leaving less metal available for private investors. The London Bullion Market Association, LBMA, and COMEX inventories continue to dwindle, creating a situation where paper claims far exceed actual deliverable gold. Macleod warns that this imbalance cannot persist indefinitely. Once confidence in these paper markets breaks, a violent repricing could occur, one that redefines gold's real market value well beyond current levels. In his broader outlook, Macleod envisions a scenario where gold does not just appreciate, but fundamentally reshapes the structure of global finance. As fiat systems falter under inflationary pressure and loss of trust, gold's role could evolve from a passive store of value to an active medium of exchange in international trade. He believes that nations prioritizing tangible reserves over speculative assets will emerge stronger in this new paradigm. For long-term investors, this transition marks not merely an opportunity but a warning. Those aligned with real value stand to gain, while those clinging to fiat illusions risk being swept away by the coming monetary reset.
Now, this is really timely because I think what you're saying here, look, wake up because this is real. It is a problem. It's going to happen. And obviously there is an opportunity. And especially you talk about gold and silver. I mean, look at every other currency, every other fiat currency that prices gold and prices silver has been through the roof a lot, led the way higher. And I look at CNY silver, Euro silver, forget 2011 highs in dollar silver. It's through the roof. It's just every day. It's higher and higher and higher. If anyone wants to me, I'm saying to everyone right now, why would you not go after, swap some dollars for silver now? Because it's your arbitrage. It's quite clearly undervalued. They've been sitting on it a long time. There's obviously a lot of short stops above the market. Otherwise, they'd have raised the margins on it by now. And it's a panic. So to me, that's what I'm saying, people, right now, what should I do right now? And I'm agreeing with you. Silver has to be a bargain.
Yeah, oh, absolutely. And I mean, there's absolutely no monetary use priced in it. I mean, if you've got a gold silver ratio of 80 odd, if it was going to be priced properly as money, you'd be looking way below that. I don't think we get back to the sort of Sir Isaac Newton, 14.5 ounces of silver to 1 of gold type thing. But I can easily see this below 30, in this sort of panic. And that does give you, sort of huge outperformance. And of course, the other thing is that while the institutions might be fretting about where the hell we're going to get all this gold, the average investor, the man who feels that he's missed out on the gold run is going to go for silver. He's bound to. Because apart from anything else, he doesn't have to fork out the thick end of $4,000 for an ounce. He can buy an ounce for around about 47, 48. So that is extremely attractive, I think, to most people. So I do see a bit of leverage there. The other thing possibly is, I mean, I think that institutions will go for gold mines and silver mines and so on. And I think the overall mining industry, I think, has been very, very suppressed in terms of its value. If you look at the main indices, they're more or less, talk about mining's, gold mine index or whatever. They're more or less double from the bottom, but this is from very, very depressed levels. But it does mean that you've got to have the ability to analyze mines, or at least know who to follow, which is probably, what most people will do. That introduces a degree of complexity. As well as that, if you buy into stock shares, whatever, I mean, basically you're buying credit again. And now I know people think that a company isn't inflation proof, or it proves gives you some protection from inflation. But the problem there is that it is still credit, because what you're doing is you're buying into a management promise to give you a stream of dividends. Well, they don't even pay that nowadays. So
you're just treading water. Then you're just treading water. You're not doing anything.
Yeah. I think the key to it, Andy, the key to the acceleration in the market is going to be when this credit bubble pops. I think we're within months of it. I mean, in fact, I think it probably happened by the year end. October seems to be, and here we are on the 1st of October, it seems to be a pretty good month for a crisis.
If the current momentum continues, the coming years could witness one of the most profound monetary shifts in modern history. The global economy appears to be moving away from inflated debt-based systems and returning to the stability of hard assets like gold and silver. As faith in fiat currencies fades and geopolitical tensions accelerate, central banks are likely to expand their accumulation of precious metals, quietly preparing for a world less reliant on the US dollar. This transition could spark a major repricing event, where gold breaks through multiple record levels and silver follows with even greater volatility, reflecting both its industrial and monetary value. At the same time, shrinking supplies and rising physical demand may expose just how fragile the paper markets for metals have become. When the gap between paper and physical prices finally widens beyond control, it could unleash a cascade of revaluations across global markets. Investors and governments alike will be forced to confront the reality that tangible assets, not digital tokens or fiat promises, represent the only true form of lasting wealth. In this unfolding landscape, gold and silver are poised not just to rise, but to redefine the very structure of global finance, signaling a return to real value in an age of uncertainty. If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.